Welcome to Transition Talks, Business Exit and Retirement Strategies with Josh Ackerman. Get ready to be immersed in real-life experiences and strategies of business owners who have transitioned their enterprises, whether by selling or handing over the reins to the next generation. Through candid conversations and expert insights, Josh aims to provide practical tips and proven techniques to tackle the complexities of succession planning. Let's embark on your next chapter together.
And welcome to the Transition Talks podcast with Josh Ackerman. Josh, usually I really like being with you. I enjoy our conversations, but I'm sorry. We're not talking about death today, but we are talking about that other one.
The other guarantee.
Yes.
The taxes. Yes. The T guarantee. Yes, indeed.
So how, are you going to make this easy for us, or what? Are you going to shed some insight and some knowledge with us?
I've got some knowledge. I've got some things to think about. I'll give away the ending. The earlier you start thinking about the sale, the better off you're going to be, which I may have mentioned a time or two on this program before.
You have.
And I think the piece to keep in mind is the number that you want to pay attention to is not necessarily the first number. It's the number that you get to put in your pocket at the end of the process.
Well, that first number can be very distracting, though, Josh.
Oh, the first number is the number that you hear someone says, so-and-so sold his business for $10 million. Well, that's great. 10 million is a nice round number. It's got a lot of zeros. But when you dig down into the reality and you figure out, well, how was the deal structured, which we'll get into and which matters? How was the business structured? Turns out that matters too. All of a sudden, the $10 million becomes a smaller number, and it can become a smaller number. You know, you could be talking about someone walking away, all done, with $3 million in the bank.
Wow. And
$3 million is certainly nothing to sneeze at.
No,
right?
it's not, but I'm thinking it's not to sneeze at all, but I'm thinking about that $7 million out there somewhere.
Right. That is not 10.
Right.
So we've got to be sure that you're thinking about, this is what the business is worth. This is the check someone will write me. That's great. Now let's do all of the necessary deductions and then talk about what the number is.
So what are the secrets to maximizing that second number?
So the secret is, depending on how your business is structured, would be the first place to look.
Okay.
With an LLC, an S Corp, a partnership, which are considered in the world of taxes a pass-through entity.
Sure.
Meaning money comes into that business and goes straight through to the owners. And so that means the money is taxed once at the owner level. There's no tax at the business entity level.
Gotcha. Okay.
As compared to a C corporation, and I apologize, this episode is going to be somewhat jargon heavy. There's kind of no way around it. But in a C corporation, money comes into the business. The business is taxed on that money. Then money is taken from the business, paid to the owners, and taxed a second time as income to the owners. So the danger there is the owner winds up paying tax twice.
Well, why? There has to be an advantage. I mean, why? I mean, there has to be a reason why you would opt for a C corp, not because
there are advantages, and those advantages exist when in almost every situation other than when you're selling the business. And when you're selling a C corporation with a small number of owners, Coca-Cola, for example, is a C corporation.
Gotcha.
And there's tax benefits in running that business as a going concern. Again, there's benefits in kind of every situation except for the situation when you go and sell it.
Yeah.
Then it becomes not as great an option.
And just a word on the jargon here. For most of the people who are listening to this, obviously, are, I think, very conversant in the jargon, as it were. But for those who aren't, most people should probably understand that most small businesses in America are the pass-throughs, the LLCs.
Yes. Yeah, certainly. And with the C corporation, you can get around some of this. You can do a stock sale. The buyer can buy shares of stock, and you can get around some of this C Corp taxation. And let me clarify something real quick. I am not, in fact, a licensed tax preparer under the codes of the IRS.
Right.
Anything I say about tax is at best a good idea that we should perhaps take to your tax professionals and have them walk through it. I can raise the idea with your people. I speak enough tax that I can have that conversation and understand most of it. But I'm not the last word in how we're going to structure your deal to maximize tax. That's what the professionals are for.
Exactly. But for the purposes of this conversation, these are things that you should probably think about and consider, and take that to your tax professional and say, hey, what about this?
Right. So when we're looking at the asset sale versus the stock sale.
Okay.
So when we're going to buy the business, we could buy the assets or we could buy the stock. And with an asset sale, let's say it's a construction company and it's got bulldozers and trucks and cranes and all sorts of things.
Sorts of equipment and stuff, yeah.
All sorts of equipment. And we're going to buy the assets of the business. That works out great for the buyer because there's tax deductions that go along with buying assets.
Okay.
And depreciation and all of these other things that come along with it. The seller would prefer the stock sale because there's benefits to the seller in that situation.
Mm.
And so you create with a informed buyer and an informed seller, you can see that you then get to a conversation about, well, if we're going to do a stock sale, the price is going to be $6 million. If we're going to do an asset sale, we're willing to give you $8 million.
Oh.
Because, again, stock sales better for the seller, asset sales better for the buyer. If both sides understand that reality going into the deal, they can have the conversation about, this is the price I'm willing to accept because I can do kind of the rough math, or in a large enough deal, I can do the math down to a very fine grain to figure out how much of this top number I'm going to have to give back in taxes.
Yeah.
Right. So if you understand that the great big number that you see the buyer offer you the nice round number with a lot of zeros, and it's got a bow around it and sparklers and cold champagne, and it's just a great deal, it's worth obviously looking a couple layers below that number to figure out, what does this actually mean for me? And I would suggest that's the number you want to have, you want to understand, given your individual situation. And you may be able to sit down with your accountants, and they may be able to give you, maybe able to say, Bill, in your negotiations, any number they give you, I want you to take 40% off the top and assume that that's going to go away in taxes.
Okay.
And so as you negotiate, and they give you a number on the asset sale that they would like, cut that down by X amount, by 40% in our example. And that's the number that you compare. Again, because that's the number that is real. Everything else is a game. Everything else is, the shell game, right? We're just moving stuff around.
Well, no, from what you're saying, you actually should never enter into negotiations without a good, solid tax professional on your side to help you understand the numbers from the get-go, or you don't know what you're negotiating.
Right. Yeah. And I think it would be fair to say, and some of the accountants that I've worked with and talked to, they will say, okay, let's pretend you get to sell this business for $10 million. Let's pretend your business is worth this, $2 million of earnings before taxes and deductions. We're going to sell it at 5 multiple. We're going to sell the business at $10 million. And this is how much you would get to keep. And if you're using a investment banker in the middle, a business broker, you want to figure in those fees.
Yep.
And you want to do kind of all of that math and understand with whatever number makes sense to start with, but any number, and get an idea of what kind of deductions are we really looking at. And if somebody says, I'm going to hand you a check for $10 million, how much of that do I get to keep? Because again, that's the number that matters.
Yeah. Yeah. Well, it's funny because I would think most business owners would know that, but I think they might get distracted by it because that first number is so, wow.
Oh,
10
definitely.
million.
Yeah. No, I think they understand it certainly because at some other place in their business, they've seen top line revenue and bottom line profit.
Right.
Right. So that the idea is not new, but the size of we're going to write you the check can be so attractive and so compelling that it's easy to kind of forget that the math on this transaction is going to be the same math as every transaction you've done in your business career. There's going to be the number that comes in, and then there's the number that you put in your pocket. And those aren't the same number.
So I realize it's hard to get specific because we can't get specific because every situation is really different. But I'm guessing, in fact, I'm sure that there are ways that if you're getting ready to negotiate just the sale of your business, that you can minimize the impact of all those taxes, right? Is that
certainly? Well, let's say that we have, and this is a somewhat exaggerated example, but it makes the point.
Understood.
Let's say you have an LLC and the business is a knowledge business, a service business. It's not dependent on stuff. It's not particularly dependent on location.
Okay.
It's currently headquartered in California. And you decide in the next 5 years, 3 years, 2 years, I'm going to sell this business. And I'm going to spend my time living on the Florida coast and go fishing a bunch. That's what I'm going to do. That's my retirement plan, says fishing a bunch, underlined. It makes some sense in that situation to go ahead and move to Florida because there's no state income tax.
Ooh.
Versus the transaction being done in California, where there's quite a bit of state income tax.
Mm-hmm.
So they're now transitioning from a C corporation to an LLC or a pass-through is certainly possible. I don't know all of the hoops that would be required to jump through. So maybe that's a good idea, maybe it's not. But it does matter how the business is structured, and it matters where the sale is done.
Seems pretty simple and pretty obvious, but not really.
Not really. Well, it's simple and obvious because you and I have been having the conversation that comes back every single time to, well, if you plan about that out a little bit and you start thinking about that ahead of time and you talk about, well, what's going to happen after we sell the business? What is it that I want to do? Then the options you have to minimize taxes become more doable, right? You can talk about, well, these are some things we could do. That's something else you would want your accountants to come up with. These are some things we could do that would minimize taxes. And hopefully if they know the business is domiciled in California, but you're going to be in Florida the minute the check clears, they may say, hey, Bill, why don't you go ahead and move to Florida, establish residency, however long that takes, and now it's a Florida transaction, no tax.
This comes back to something that you talk about quite a bit for those who have not listened to Josh's earlier podcast. But you talk a lot about preparation. You talk about, and you've said repeatedly, you don't just wake up one morning and decide you're going to sell your business. It's not going to happen. You're not going to sell it next week. It's going to take you probably about a year. So if you're thinking about selling your business, you're smart to be preparing to sell your business, and you can better maximize the advantages that are available to you to take home as much as legally possible, right?
Right. Exactly. And it may be that there's an option that you could do that would minimize taxes. And we put the option in front of you and you say, yes, I recognize that option would minimize taxes. I'm not interested.
Oh.
And there's nothing wrong with saying, I don't want to do that.
Yeah.
Right? A much smaller, numerically, a smaller number. My grandfather was a lifelong estate planning attorney. And he put together his estate plan and told my father, who at the time was an insurance agent, this is the plan. And you and I both know that this is not the plan that minimizes taxes to the fullest extent possible. But it is the plan that your mother understands and is comfortable with. And so this is the plan that we're going to do. And I would suggest, even though the numbers are larger, that maybe the option that your advisory council, your attorneys, your financial advisor, your tax professional puts in front of you, even though there's an option that would on paper get you an extra chunk of change, you're allowed to say, I see that, I'm not interested.
Yeah, I mean, everybody always says it's always about money, but it isn't always about money, is it?
It isn't always about money. It isn't. So then we get, speaking of the attorneys in the previous comment, we get into some options that are created by the attorneys with a trust. The money that you get from the sale of the business can go into a trust, thereby dodging some taxes. Money could go into a charitable remainder trust. The idea would be that you, the owner of the business, get paid for the business. That money goes directly into a charitable remainder trust. That trust provides you, your spouse, depending on how it's written, maybe your children, with income at a specified level.
Okay.
And then upon the death of those beneficiaries, the remaining money is distributed to charitable entities that you designate.
Oh.
So for the right client, it's a really neat way to at once minimize taxes.
Yep.
And maximize a charitable gift, because the money goes into the trust, the money grows, money in the trust is invested. So assuming good stock market for the remainder of your life, the money is going to grow 7 to 9% a year, but it could be 7 to 9% a year for 30 years, depending on your age when you sell it. And the income that comes out of the trust is, I almost said guaranteed. It's not technically guaranteed, but the income comes out of the trust. And so you, the owner, beneficiary of the trust, would have income coming in. You can designate the beneficiaries, the charities that get the money upon your death, and you can change those beneficiaries at any time. So a charity, a local charity that you love right now, that does great work, goes the way that some charities go and starts to spend more money on administration than they do on solving the problem that they're created to solve. And you can say, those aren't the people. I'm going to move my money somewhere else. Someone else is going to get this benefit. So there are ideas like that out there that can do a great job of helping with the tax question. And for the right client, if the money is probably going to go to charity anyway, this is a great way to do it.
I like that. I like that a lot. So, Josh, for people who are listening to this podcast who may not have a relationship with you, but think maybe I should have a conversation with him, what is the best way for them to reach out and maybe initiate some talk between them and you?
The best way would be the website, contextfinancial.com. And my email and phone number are on there, and you are welcome to reach out at any time. And we'll talk about whatever questions you have.
And do. I would encourage you, if you're intrigued by the conversation and you find this interesting, I can guarantee you that you would enjoy the conversation with Josh, if nothing else. So do reach out, give him a call. And if you're not a subscriber, I'd encourage you to be subscribing to this podcast. And all you have to do for that is hit the follow button. The reason to do that is that when you're a subscriber, you are automatically notified every time Josh drops a new episode. You can give it a listen and see if you learned something there as well. So, I don't want to get out of here without saying, if you like the podcast, do us a favor and rate it. Give it a nice rating and share it with people. Word of mouth promotion. It's a beautiful thing, and we'd really appreciate it. So until next time, on behalf of Josh and everybody at Context Financial, I'm Bill Tucker. Thanking you for taking the time to listen. We'll catch you next time.
Thank you for listening to Transition Talks, Business Exit and Retirement Strategies with Josh Ackerman from Context Financial. Are you a business owner looking to sell or make a transition? Connect with Josh on social media using today's show notes links. You might just be his next guest. To ensure you don't miss a new episode, please click the follow button. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Context Financial. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.